I'm joined today by Philippe Gijsels, the Chief Strategy Officer at BNP Paribas Fortis and co-author of The New World Economy in Five Trends. I must admit, I have a real soft spot for Fortis. I actually started my own career at Fortis Investments in Brussels 20 years ago, so it is a personal pleasure to have Philippe here. He's a strategist who can see through the noise to identify structural waves moving the global economy, and whether he is discussing currency debasement or physical realignment, his perspective is one of, I would say, the institutional investors simply cannot afford to ignore. Now, welcome, Philippe, and
Thank you for having me.
In your book that I just mentioned, you identify these five defining trends. Superinflation, number one, hyperinnovation, number two, climate transition, number three, four, multi-globalization, and the last one is demographic shifts. And one of the most striking points you make regarding demographics, I thought when I read your book, is you're moving that we're moving into what you call a seller's market for labor for the first time in decades, and I guess that's something good, right? So as we move into this new world economy, how does the end of cheap labor, if you will, fundamentally now change the inflation playbook? Because we also see inflation has picked up substantially after COVID. And what does that mean for central banks? Are we moving now into a decade, you would say, where the worker finally has the upper hand over capital, or how do you assess that?
Well, that's already a lot of questions in one. Thank you for that. Now, first of all, you've mentioned all the themes we discuss in the book, and except for one, namely innovation, they're all inflationary. So we've written the book more than 1 year ago, and it may sound a little bit arrogant, but I would not change one line in it because I'm even more convinced today than I was back then that this is a fourth turning. We can talk politics afterwards, but all these things are leading to a world of higher inflation and also higher interest rates. That's very important. And demographics, because we try to structure the book around these themes, but of course they're interconnected. So you come from a world indeed which was globalized. We now call it not deglobalized, but we call it more like multi-globalized, globalized around different centers, but it means that the worlds get closed a little bit more and all workers get less in competition with the cheaper labor from the other places in the world. So the supply chains get shorter, and it means that the workers finally have some bargaining power. Add to that the demographics, where people get older, and only continent where you will see increase in the populations will be Africa, India, but that will also top out in the next couple of years. So you have less supply, and that means indeed for first time, and that's a major driver for inflation as well, that some of the workers, not all of them, will have some bargaining power, and the ones who have really the skills to work in this new environment can probably demand some more money. That means equity markets may be getting a little bit more complicated, because if you look at it, and it's not a political view, the point is if you look at the total added value, it went mostly to the shareholders and less to the workers. That will change. So, but as you said, this with all the other things we're probably going to discuss today will lead to a more inflationary world. And it means that central banks are indeed, as you mentioned, probably in a tough place, because it was very nice to be a private banker. Volcker at the beginning of the 80s, and we go back a while, so you remember him. He had a tough job of breaking the back of inflation. He did. But after that, you got Greenspan, you got Bernanke, you got Yellen, now you get Powell, which is a little bit more complicated. But the previous one, it was very nice to be a private banker, because you could play the hero each and every time you have a crisis. Easy, you lower interest rates. And if that does not work anymore, or you're at zero, you start with quantitative easing. And inflation is never an issue. So you can be Superman or Batman or whatever you want to be and save the world. But of course, when you enter this world where inflation will be a structural problem, and then the economy goes down for whatever crisis you have, you're in a tough spot, because you can choose between stimulating the economy and letting inflation run, or cooling down the economy to bring down inflation, but then you have a recession or whatever, and then the stagflation word comes up. So it's not so easy to be a private banker these days. And yeah, I think demographics play a very important role in this as well.
Well, it's very interesting. And I often look at central banks, you could almost think about it as a distortion of the price finding mechanism. But then in the end, that's our reality. And probably on balance, it helps to prevent crisis like we've seen in 2008 and also during COVID when central banks step in. And, what I find currently a little bit almost interesting is the Fed. I think, we see. Of course, the stock market has gone up and up, but we also think there might be a bubble in some segments, like AI, for example. And I think the Fed doesn't really care about AI. What they care about are banks, right? And the balance sheet of banks. So, and what's your take there specifically on the current, move to buy bonds from banks and other entities to ensure liquidity is there? Because it's hardly discussed these days. We look at interest rates, do they go up or down? But there's also sort of a hidden quantitative easing, if you will, going on, right?
Yeah, absolutely. And that's also a couple of very interesting points. Now, on the bubble in AI, I'm not so sure about that one. Maybe we can discuss this later. But with the other points you make are absolutely valid, I think. We come from a world where central banks have saved the world for so many times that everybody, all the investors are very used to buying the dip and buy the dip and you always make money. If you also look at the speed that markets recover, I remember back the internet bubble, okay, it burst and then it took until 2023 for the bottom and then to somehow move up again. The financial crisis that we talked about off camera before a little bit, we were both in that one, 2007, 2008. It took quite a number of years to recoup from that. But now if you see COVID, if you see last April with the tariffs, if you look at today, markets come back very quickly. And that's on the one hand, indeed, central banks pumping liquidity in the system. On the other hand, investors, I think, that have gotten so used to just buying the dip and you always make money that they don't even question it anymore. And that is at the end
Right.
of the day, maybe a risk. And I'm working on a new book normally for next year somewhere. And one of the questions I'm asking myself is this still a free market? Because it is a free market, and you mentioned price discovery and so on, where you let prices find their way. But you have active central banks that actively intervene in the market in a way disturb all this price discovery. So that's already one thing. We live in a world when we talk about that in a second, that's exactly the same thing, where you have fiscal dominance. Central banks will be forced almost to hell about governments to find a way to keep this enormous heap of debt manageable. But it goes even further if you look at what Donald Trump is doing, and it's too easy to say it's just crazy because he does, there's strategy behind this. He's actually talking markets higher, lower sometimes as well, but mostly higher. Hey, look what's happening. Okay, we have a big problem. We have a blockade. But the Iranians called, so we're going to talk. So each and every time that the market goes down 3-4%, you get some sort of a headline. There are algos for the hedge funds that are probably working on these headlines. We have a deal. We're going to talk, whatever. And that is picked up by the markets very quickly. So I have the feeling that markets are no longer allowed to go down, which means that you never have a washout, you never take away the excesses, and that's in the long run, I think, pretty scary, I guess.
Which, of course, is very important from a strategic asset allocation perspective and also from a macro investing perspective. I'm always skeptical about the pure macro investing part because I don't think you can time that. But I think what I liked about your book in particular is that you make that very actionable for wealth management clients, so to speak. And you talk about the HALO framework, HALO, right? Heavy assets, low obsolescence, and you basically make the point we're navigating towards a material world, which it's interesting because it happens at the same time as AI, and AI has also a material part in terms of infrastructure, in terms of data centers, of course. And you argue that we are shifting away from pure digital abstraction, as you call it, toward a reality of physical scarcity that becomes a primary driver of wealth. And that's, I think, something clients can take on board. Say, how do I profit from that, right? And as you know, now the traditional 60/40 portfolio, I think most smart people now, yeah, it doesn't work anymore. Question is this hollow framework that you mentioned there. Is that the new standard you think for resilience, or is this just a additional component we should consider in a overall portfolio allocation? And what does a portfolio look like when you think, paper markets are no longer the safe haven that it once was?
There is a lot to unpack in what you said. First of all, the halo, I think it was coined by Morgan Stanley or somebody,
Okay.
or by Goldman Sachs, I believe, the term, but we had the same idea without mentioning the halo, because that came, I think, about a year ago that it was first mentioned. So, but we talked about real assets already some time
So
ago.
I
And
thought you were the inventor. Okay.
no, no, you're very kind, but sometimes we invent something, but credit
Right.
where credit is due. But we came with the idea of real assets, and clients very often ask, do you have to change your PowerPoint when you do a presentation each and every day? And then I say, I have added a couple of slides because, of course, you have to add something about the Middle East these days, and everybody talks about the Strait of Hormuz and so on. But the basic framework of the four turning we talk about, and the basic framework of being in a world where money is all monopoly money, and the only way to have all this debt, this enormous debt load that we have, serviced in a way, it's about 39,000 billion in the US and counting. It will be 100,000 billion somewhere in 2048 if they carry on like this. So it's massive, and it's not only the US, it's everywhere, all on the government balance sheets. So they will keep printing money. And if they keep printing money, well, in fact, yeah, it means that money is not a good asset to be in. If inflation runs from 4% somewhere, and we lived in a world where inflation was between 0 and 2 forever almost. Now it will be between 2 and 4, and then with upshoots, spikes somewhere. Well, say it's 4. Well, if you do that 10 years in a row, well, it means that your purchasing power of the euro or the dollar or the yen or whatever you have in your bank account will lose about 40% of its purchasing power in 10 years' time. So you're absolutely convinced that that's going to happen. So that's a losing value proposition. You don't want to be there. And if you take that logic one step further, well, you come up with real assets, and then you come with real estate and gold and mines and equities, everything that's tangible. And what you've mentioned, indeed, we live in a virtual world. We build virtual worlds, but the more virtual worlds that we build, and Madonna back in the 80s, you still know her, you're in the same time frame, I guess, that you lived at era, I will call it, than I am. So material girl, well, this is a material world. The more virtual worlds we build, the more we need the molecules and the atoms of the real world. Well, and that's going to be exciting, because that's a massive investment opportunity. If you, with all the horror and all the war and all the death and all the destruction you have in the Middle East, if you take one investment idea home from that, well, it means that also commodities have become so
Right.
important. The Chinese, they have realized that they are very dependent in energy. So they will invest in coal, in solar, in nuclear, in wind, in gas, and whatever they can get their hands on. And the US, they've understood if they want to have their airplane carriers and their boats and their tanks and everything, well, they need rare earths and critical minerals. They don't have enough of that. So they will push
Right.
again on Greenland, they will push on Ukraine, and they will invest like hell in everything that's commodity related. So this is, and I've said it already a couple of times before, this is the largest bull market in commodities the world has ever seen. And what's happened in the Middle East the last couple of months only reinforces that proposition.
Right. Yeah, I heard Mark Anderson recently called that AI, basically compared that saying, this is like the most valuable thing in the world is thought that's created through AI, but what is behind it is sent, right? Something physical. and the then is turned into semiconductors that eventually gets us to AI. So there's always a link to the physical world. And you and I think, share a very positive outlook on gold. I heard you on a recent podcast talking about that and the mining sector. I've been invested a long time in mining, and it had some bad periods, and now we see this is really coming back, of course, driven to a large extent by the price itself. And you've been very vocal, of course, about the fact that central banks may eventually choose inflation to manage debt. You just mentioned that, and fundamentally that changed the fiat currency. Now, you even put out that $10,000 goal for gold, and that felt high compared to most banks, but it also feels like part of a great physical realignment that you just mentioned. It's not simply gold, but also other things like copper, energy, silver, and so forth. So for institutional investors who have historically avoided the kind of volatility you see in mining equities, and I see that clearly in my portfolio, which can go up easily by 20% in a day and down by 20% in a day. Why is this still a structural turbo opportunity, you think, of the current cycle? Is the physical scarcity here the black swan, if you will, that the market is finally waking up to?
Yeah, absolutely. Now, if we go back in the book, we mentioned 4,000. I think it was 1.5 years ago or something like that. I remember gold was 1,600, 1,700. And we put out 4,000, and everyone said you're absolutely crazy. And we also wrote that probably copper could double and so on, because that's the electrical revolution and stuff like that. So then we went to 5,600. And we corrected, because I think it's most of all two things happening at the moment to the gold space. First of all, interest rates have been going up, and as we very often mention, in our world, interest rates are like gravity. If gravity is zero, everything can fly. When inflation goes up, or gravity is higher, so it means that a lot of assets, equities, but also gold, real estate, well, they have more difficulties to move higher. That's a point. And then probably central banks have been buying very aggressively and continue, like the Chinese, to buy. But Turkey sold some. I can imagine that in the Middle East, they have other things to do than buy gold these days. So that there are two things that are at play. But I think your official view of the bank is about 6,000, where most people are. But I wanted to make a statement and saying, okay, I put out what looks like a wild number, but in my mind it's not, because the thing I wanted to say with this, and I also mentioned I think 200 silver and so on, that this is by no means over. This is just the beginning. To talk in baseball terms, this is not the first or the second inning, but certainly not the last inning of something that will be huge. And it's not limited to gold and silver or platinum or palladium or what have you. It's copper, it is the rare earths, it's the energy space, because the point that we've been making to clients since the beginning of the year, said last year is a commodity year, this year will be an energy year. And that was not because I had a crystal ball and I was talking about the Middle East already, but because I said, yeah, oil 60 looks to be the bottom. And I think in a way the Permian base will top out in the not too distant future. So 95% of all the additional barrels of oil the last 10 years came out of the shale of the United States. So if that tops out, gradually the market would go in equilibrium, would go in deficit, like so many commodities at the moment, and also energy would go up. Of course, now at the Middle East, it went faster than we thought, but I do not see the price of oil going back to 60. I think we're also on a sustainable uptrend. And then you come to the miners and to the drillers you talk about, and there I think that the game still has to begin. And if you look at a lot of the miners, the big guys, the Barricks and the Newmonts and the
Valuation at 10 or something. Where can you find that, right? In tech, it's like
yeah,
30,
indeed.
40.
Indeed, you find it in tech as well, because I'm also bullish on tech. I think a lot of interesting things are happening there as well.
Right.
But the point is that indeed you have a big move up in a lot of these names, also in the juniors and the mid-tier miners. and so on. But if you look at the valuations today,
EDXJ, yeah.
quite a bit of them quoted, even at not 5.5 gold, but 4.5 gold, or 4,700 or so, where we are today, more or less. They're still coining money. You buy them 8 times earnings, 6 times earnings, 5 times earnings. And what typically happens in this time of the cycle, and of course the last cycle was the 70s, so a lot of people do not remember this. And as you mentioned, a lot of these miners have been horrible investments for the last 25 years, so therefore a lot of people will not touch them. But what typically happens is that, okay, the big miners, they make a lot of money, they see the share price go up, they can use that share price as a currency to buy mid-tier miners, and the mid-tier miners can use their share price to buy junior miners. That's what typically happens. And then we've only started this. And last week, and it's a name that maybe a lot of people do not know, and even I did not know, you had G2 mining, I think it was. It was a smaller miner, and it was at 35 cents some time ago. It was $6. Then it was taken out at a premium of 50%. So it means that there is still value to be had, and it takes you know that better than I do, it takes you 10 to 15 years to find a new resource, build the mine, get the financing, get the permits, get everything. So it's very often easier to buy something that's closer to production or already in production, and I think that's going to happen. And it's not only gold and silver, it will be gold and silver, but it will be rare earths, it will be copper, it will be nickel, it will be lead, it will be everything. So this is a very interesting space, and space that is under-researched, because a lot of people do not look at these things. Very often they have small market caps. There are not a lot of analysts who follow it. So it's a very inefficient part of the market. So I think there is still quite a bit of money to be made there.
I hear a lot of analysts, more the traditional ones, countering that and say, oh, this is all about Russia and Ukraine. Basically, the Chinese got scared that you guys in Belgium, right? You froze those Russian assets, and that could happen to us. So let's buy gold instead of putting it in US dollar. I personally, and I would like to hear your opinion, I see that as a contributing factor, but not as the main driver of what we're seeing with gold, if you agree.
Well, I agree. I think it was a driving factor at the beginning, because
Right.
up until the beginning of 2025, the price of gold going up was almost solely a central bank thing, because of the reason that you mentioned, and everybody says, I do not trust the American dollar and the American treasuries anymore. If you look at the Chinese holdings, it's below 1,000 billion of the 39 in total. So in percentage terms, it's not as big anymore. They're now the Japanese who hold a little bit more. They're not the Chinese anymore, so they sold down quite heavily. So the entire world said, give me something else than American treasuries. And that was the initial driver. And you could see that very well. You could see that in two places. First of all, we monitor, of course, the holdings that these big trackers, ETFs, have. And there you saw that up until 2025, the beginning of last year, investors were actually net sellers of gold mines and also gold. And central banks were buying it up, so it means it went up, but investors were not on board, even they were selling. And if you look at the market itself, up until the beginning of 2025, the only thing that went up was gold, because that's what central banks were buying. Silver was not going up, and miners were not going up. So
Yeah,
all the
that's the
stuff.
question I have as well with silver. It almost scares me a little bit because I'm also invested in silver and silver mines. And I see it's almost like a leverage play on the Nasdaq. And I would rather see it as a contrarian play, not as one where I see this going up as much as Nasdaq or even twice as much on a good day, right? And I think the argument is here that silver has two functions. One is part of the economy. So if the economy is doing well, silver is doing well, but it also follows gold in the long term with a delay, correct? But how would you assess that for an investor who is like a little bit skeptical on silver?
Well, that's a difficult question and also a technical one. But the point is, if you go back to the beginning of 2025, then investors came on board, and also silver will start to go up, and also the miners started to go up. And then you saw these holdings in the ETFs going higher as well. So at that moment, you almost knew for certain that investors are on board, and then you had a plane flying on two engines, central banks and investors. Now,
Right.
to your point, indeed, silver is half of it more or less is industrial. So you need it in a lot of applications. I used to use it a lot in everything that had to do with photography. And of course, there it lost its demand. So yeah, on the industrial side, it was not very big for many, many years. But now you use it in solar panels and batteries. If you have a solid state battery, it's about 50 grams silver, so that's fantastic. You have about, I have not the exact number, 20 or 30 different places in a car where you use it. Not a lot, but still a bit. So it's about 50% in the new technologies. So that makes it very powerful. And silver is also in deficit. Now, an interesting point that you do not like it to be, let's say, a turbo or a leverage on the Nasdaq. Unfortunately, if you look at the last couple of months, since interest rates started to go higher, both gold and silver are correlated with equity. So the days typically, when you have a good day in the market, equities go up, but gold and silver go up as well, and the euro goes up, so the dollar goes down. On a bad day, equities go down, the dollar goes up, and gold and silver go down with equities. And of course, you would like that to be decorrelated, because that comes back to the point you made before about the 60-40 portfolio. You try to find stuff that's decorrelated with what you have.
Right. What happens if we get a 40% drop in the S&P, right? Will that all drop, or will gold and silver perform, better than the rest?
The proof in the pudding will be in the eating, of course, in this one. But I would think, as we have seen before in the past, that it will initially go down, also the miners, because to a certain extent there are equities as well. So they will probably go down to a certain extent with the S&P. But eventually, if things go bad enough, I think that gold and silver and so on will start to outperform. So it will play this role. But at this moment, you can only observe. Predicting is always difficult without a crystal ball, but you can only observe that the two are correlated. And that's something you do not want to see. Now, the 60-40 portfolio story is something we look at very closely for our clients these days, because we all know in an inflationary world, as long as the world is deflationary, the bond part, when equity is correct, interest rates will go down, you will make money on the bond side, and you will be compensated to a certain extent. If inflation goes up and interest rates go up, you lose on the two sides, so you need something else. In my mind,
what is your expert view on what happened end of February when we saw these huge drops, both gold and silver, in 1.5 trading days? And I was listening to some people saying, oh, this is COMEX, right? The old story, they're manipulating COMEX. And yes, you have that big difference between Shanghai and London. But do you think that was just a minor blip, or was that a sign that something is not right here?
Well, you cannot probably not call it a minor blip in silver, because we came down from 120 to 70 something very quickly. So that's a big move, I guess. Gold was a little bit less spectacular, but we'd also talk about $1,000, which is not nothing probably. But strangely enough, maybe if you look at it technically and you describe an uptrend by the 200-day moving average, which is the simplest way, they're both still above that. So even with the correction that we had, so I would, and now I go out on a limb here because it's just a hypothesis, but I have a feeling that we went also maybe too far, too fast. I always had for silver, for example, I had the 50 level in mind, because that was the level in the end of the 70s, the $100. That was once again touched in 2014, I believe. And I always said technically a triple top does not exist. So if you reach 50 again, you will probably break it. And then I would say it goes to 70 something. And then instead of 70 something, it went up to 120 very rapidly. Probably a lot of speculation, a lot of hedge funds on board. And then, you correct it almost logically. But I still think this is an uptrend. Now, the stories about COMEX and
No,
I, I
it's
think
a conspiracy. And BNP, of course, is part of Comex, I think, right? So you basically part of that.
I'm not
So
sure. I'm not sure about that. Could be.
I mean, it's a natural thing, right? If you have a lot of rise in market price, you have to hedge yourself as a platform like Comex. You have to put the margin calls up because otherwise, money is at risk. So I think it's a natural thing. The only thing that was a little bit odd was that you had circuit breakers didn't work, or little things were making people feel uncomfortable. But I think it's a long story, and I don't buy into it. I think it's in the end is demand and supply, right? And these long-term underlying
It's
trends.
important, I think, as well to look at the physical world once again, because on the front
Right.
end months you typically have these. Yeah, the speculators are also in the oil market. It was strongly in backwardation because the short end is up a lot, and everybody thinks it will be resolved on the long end of the in time. So the long end is more slower, is flatter as well. But the speculators are mostly with these things. So if you look at the longer end of whatever commodity, yeah, there are
Right.
really the hedgers, the buyers, the sellers. So you get more into the physical world of things. But I think what I'm surprised, honestly, oil went up and it went up to 120, for example, and now it's sitting around 100, I think, as we speak. But a blockade of the Strait of Hormuz, if you would have asked me before, where do you
Right.
think that oil is going to be? I would have said 150 or 200 or something like that. These are case studies at big US and everywhere business schools that the people have to make a prediction or whatever. If what happens if the Strait of Hormuz, which was always almost an urban legend, would be closed? No, you close it
Right.
already for a month. So I think the physical market in oil is way worse than what the price is telling us at the moment.
Right, right. And maybe if you can come back just to hyper innovation, because you mentioned that. Do you think that's moving fast enough to outrun the interest payments on our global debt? Because the other side of hyper innovation is what you call superinflation, right? So can technology now solve this, you think, through more productivity? To get control over the debt wall, or are these two different topics where we need to deal with debt from a sovereign perspective, cut our spending and live within our means, and then on the other side we have technology taking care of productivity?
Yeah, that's a difficult one, and I'm afraid I don't have the answer to that because that's a question that's up in the air in our book as well. So you have four forces that are clearly inflationary, and then you have the innovation part. And as you have read the book, it is an optimistic book because you also try, above all, you try to see the opportunities in all of this. You have massive risks, massive challenges, but you also have massive opportunity. And on the innovation side, yeah, what's coming. We try to get our heads around what AI is and how big it will be. I have a feeling it will be huge. So it has a
Right.
potential to be hugely deflationary as well. Maybe, I don't know, maybe it's big enough to counter the other ones. That's possible. I think we live in extremely exciting times. But I also think this will create a lot of dislocation. And if you take the two together, in the one hand the debt and then the inflation you're going to create, it's also once again creating a lot of asset inflation. You create
Right.
prices of real estate going up and so on. So the inequality in the world will rise. It will be compensated by the fact that some workers have more bargaining power, as we discussed at the beginning. But all in all, everything that the central banks are doing in a way is increasing strongly the inequality, which leads to populism and then all the things we see in a lot of countries. On the other hand, you see the same. I think that on the innovation side, the world of the haves and the have-nots will increase massively. The people who are on board with the new ideas, who are invested in these things that create the new companies that will be worth 4 or 5 thousand billions of dollars, and maybe the next generation of these companies will be even bigger. So that's creating a very complicated world. But I think we will be surprised if we were when we're still around. I hope in 20 years time, or we discuss this again in 5 years time or whatever. I think we will be absolutely amazed by the new developments that are there, and also the succession of new technologies coming ever faster, also making it difficult for companies to monetize them at the end of the day. But I'm not an expert in technology. It's for me already. I'm already happy when we talk that I can open my Zoom. So I'm a consumer. I'm a user. I'm not an inventor, let's say. But I'm
Right.
absolutely flabbergasted and excited about all these things that are going to happen, which will also lead to massive.
But sometimes healthy to have a helicopter view and not to be too much in the weed, right? When it comes to technology. But I was just wondering, what's the impact on the profit margin of global corporations over the next decade, you think? Is this going to be positive or negative? I mean, we have multi-globalization, we have supply chain issues. You mentioned the Strait of Hormuz, but we also have this, really hyper innovation trend out there.
Yeah, that's a very difficult one, because indeed your labor costs will go up probably, your taxes will go up probably, your input costs for energy, for commodities will go up probably. It will cost more to build your data centers and whatever. On the other hand, you hope that you have a massive increase in the productivity will compensate for that and still create high margins. Now, if you look at the margins today of a lot of these technology companies, they're huge. Everything
Right.
that's in the semiconductor space, it's amazing. If you look once again at the Middle East, that you have we can call it an oil shock. We don't have to be childish about it. This is an oil shock. But if you look at the earnings estimates over the last couple of weeks and months in the United States, they've been going up. So now earnings season has started. I think the earnings are still quite good. So I think, there is a massive opportunity to make money. Now, what's also very interesting in the market these days is that you have what I would call dispersion. It means that 6 months ago, a year ago, probably 6 months ago, everything that was AI, like .com, the end of the .com bubble, was fantastic and it went up. Now the market is saying, okay, who's going to benefit from this? And there's, of course, the data centers, the chip producers, these kinds of things. And then they say, software is probably going to get killed by AI. For software names have been hit. So the market is clearly making a judgment who is going to benefit from this. But overall, with the helicopter view you talk about, I think this will also be positive, very positive for earnings and for margins at the end of the day.
Yeah, and then of course last year we saw a little bit shift away from US equities to European equities, and can imagine that was very relevant for your clients as well. And for me, I always look at that and say we are way too pessimistic in Europe about our state of affairs, because there's so much potential in terms of future deregulation, future unification in capital markets and so forth, that people don't see the upside. We just had a very good election in Hungary, right? With liberalization there. We have Spain is growing. Germany is finally spending on defense and infrastructure. We see Greece has been deleveraged over the last few years. So what's your take on Europe? Am I too optimistic here, or?
No, it's a theme that we've been playing last year. Indeed, saying maybe there's too much focus on the United States. Just one figure: if you look at the MSCI World today, it's about 70% US.
Right.
US is not 70% of the world economy, but these companies have had massive inflows since the financial crisis. Basically, that's what we call the American exceptionalism. Money flows easily to the United States. When there was a crisis, everybody went to dollars and went to treasuries. When there was no crisis, everybody wanted to buy Apple and Nvidia and Microsoft. That has been the game since the crisis. And since last year, 2025, we have seen changes in that, and money has started to flow towards emerging markets, towards Europe as well. And we've been modest about it, in the sense that we just want to have a good equilibrium. You have to be invested in technology, and then you have to be in the US. But we shifted some money towards the other regions, and Europe, you're absolutely right. We have a lot of building blocks here. We have good universities, we have good innovation, we have good IPOs, we have a lot of money, because we've all been sending it to the United States. But if you would use it in our own industry, in our own continent, we could do fantastic things. What we're not good at, unfortunately, at the moment, is we're not good at scaling up things. We have not built one, not even one, company of $100 billion market cap, like a Palantir or whatever you, and that I'm still far away from the 4,000 that NVIDIA has, but we're not able to scale them up. And then regulation is very important. Resource independence is very important. So we have a lot of things to do. But as a European, as a Belgian, I'm optimistic in the sense that we have the building blocks here. We have to do better. We have to do way better. But I think probably, and I agree with you, that markets have been too negative on Europe. It's not like that all our industry is going to disappear, that we only will be the museum of the world. I'm not buying that. We have a lot of work ahead of us, but we have been willing to take on some European equities just because we had a feeling that markets were probably too negative.
Right. And maybe related, I also see a bit of a negative tendency currently when it comes to climate transition, the Americans putting it almost like an ideology, whereas in Europe, we see that as a technological opportunity to make money, in fact, right? And I think you mentioned that in your book. We can talk a little bit about that and then what is the impact here on possibly impact on inflation?
Yeah, first of all, I think indeed, if we want to be energy independent in Europe, I think we will have to go for renewable energy and alternatives, even though it will be difficult in terms of transition. And nuclear, of course, because I still think that's a good way to go. But as long as you're dependent on carbon, you have an issue. So we probably have to invest there. And it's something that we are putting forward as we speak to our clients, because last year we said buy commodities, amongst other things. The beginning of this year we said buy energy, but don't forget the alternative energy, because if prices go up and everybody wants to be energy independent, well, eventually you will also come to solar and wind and all these other things, nuclear as well. So I think there's a massive investment opportunity as well. And this has the potential, indeed, when you can scale it and you can bring down the costs at a rapid pace. And I have the feeling this is happening, that this can have a favorable impact on inflation, because if you're too dependent on natural gas and too dependent on oil and all these things, well, I think if you look at the steel industry in Europe or the chemical industry in Europe or petrochemicals or whatever you want, it will be hard. So I think there is a massive opportunity. And you see that also if you look at the stock market. Everybody, 3 years ago, everybody was buying alternatives. Then we had two and a half very difficult years. Now everybody is saying it's dead, it's over, it's not there anymore. But now you see it bottoming out and you see it going up. So I think both on a strategic point of view, as an investment point of view, it's a good idea.
Yeah, and you mentioned nuclear, right? Uranium is another one, right? Lithium, you mentioned batteries. So I think, for investors, they should look at that from an opportunistic perspective, not from a ideological one. And I think we often make the mistake, we mix this and say, oh, this is all sustainability and ESG, where in fact, this is really about a technological shift that we see here, right?
Absolutely.
Yeah. Well, so many more topics we could cover today, but I think we leave it at here, Philippe. And thank you so much. Your ability to connect demographic shifts with the kind of technological leaps we discussed today is really exactly why your perspective is so valued at One Finance World. And it is clear that while the world is in disarray in some parts of the world, those who understand these 5 trends you laid out can navigate it and can profit from this. Thank you for sharing your time.
Thank you for your time, and thank you for having me. It was great fun.